There was a guy there who was saying he was a dedicated short seller. And he just described his strategy as basically, well, I try and find wounded animals by the side of the road and then I just reverse over them a few times.
This episode is made possible by Progressive Equity Research, providing freely available, engaging investment research and opportunities to hear from a wide range of small and mid-cap UK-listed companies. In today's episode, I am joined by Tim Price of Price Value Partners, a private wealth manager in London since the late 1990s. Originally an English literature graduate, Tim started work as a bond salesman for a Japanese bank. However, he switched to private client wealth management, where he was able to develop his well-reasoned but highly differentiated approach to managing money. Tim has developed this approach based on extensive reading in economics, history, finance, and investing. In this episode, he shares the main influences, which range from Swiss-Italian Renaissance mathematician Daniel Bernoulli to the Austrian economist Ludwig von Mises and the Roman Emperor Diocletian. His strategy has three main themes, focusing on value equities, systematic trend following, and real assets. He has no time for the traditional 60-40 equity bond portfolio. Due to the unsustainable level of sovereign debt and the sluggish outlook for economic growth, he describes bond investors as dancing round a live volcano. I have been reading Tim's newsletters for a while and highly recommend subscribing. Please enjoy my conversation with the maverick, Tim Price.
Brought to you by Progressive Equity.
So, Tim, thanks for joining us today. Tell us about your background and how you came to your worldview.
So I read English at Oxford. This is back in the early 90s, and then wanted to go into either journalism or advertising. And happily, for all parties concerned, that was never meant to be. So I dodged a bit of a bullet there. And by dint of having an older brother who was already working in the city as a bond trader, he simply said, look, I know you want to do media stuff, but don't discount the city, A, because it's interesting, and B, because it's well paid, both of which happen to be true, was certainly true then. 91, which is when I came into the job market, was quite a poor economic environment. So in addition to the media stuff, I applied to a few banks and managed to get an offer from one, which is a company called Mitsui Taiyo Kobe International, aka Sakura Finance, which was a Japanese bank. And so I started my career as a bond salesman. So having studied the likes of Shakespeare and Milton, I was uniquely qualified to talk about global capital flows. So I spent 10 years in the bond market and then got a little bit tired of that. So I was with Merrill Lynch at the time in the late 90s, moved over into private banking, private client wealth management, because I wanted to stay at Merrill, but I didn't want to stay in the fixed income arena. So I moved into private client portfolio management, and then the scales really fell from my eyes. So that's really when my career started to become semi-serious. And I've been involved in private client portfolio management ever since. So that's roughly the last 25 years. One of the many problems with the city is that it tends to silo people. So in other words, you might start, say, as a generalist, say as a bond trader, and then you'd ultimately end up in let's say, the German bond market, and then you'd end up basically arbitraging 2 to 2.5 year obbles or something like that. It becomes grotesquely focused on stuff which may or may not be interesting or well paid, but the moment you start to specialize, you also run the risk of career obsolescence. Whereas as a discretionary manager for private clients, you can and may well end up, in terms of your sort of portfolio of things, either to consider or actually to use. That might include equities, might include bonds, might include hedge funds, it might include specialist funds, it might include currencies. The works is absolutely everything. The whole world is your oyster.
You said the scales fell from your eyes when you went into wealth management. How did you get from that point to where you are in terms of your investing strategy that you adopt today?
The two most influential books that I've read that I think have sort of put me onto what I consider the right course, at least for me. But one of them is, I'd be amazed if you don't know at least one of them. The first one is a book called Against the Gods by Peter Bernstein that I came across in the late 90s. And the second is a book called The Origin of Wealth by Eric Beinhocker, which I came across, I think, in the early noughties. But Against the Gods, the first one is basically a history of risk. You can't really get to grips with the investment markets in all their shapes and forms without having some awareness of what risk is. So this is actually a biography of risk. It's a fascinating book.
Okay.
But more specifically, what I extracted from it, the thing that sort of leapt from the page, and this would be late 99, so this is the first dot-com boom in all its pomp and glory, is a quote from Daniel Bernoulli, who is a Renaissance man, almost literally a Renaissance man, but like sort of a Swiss-Italian mathematician, hugely intelligent family.
The theory of propellers, I believe.
Exactly. So there's something about fluid dynamics. I'm not a physicist, but for people who do know physics, there is a Bernoulli principle, which is all to do with fluid dynamics. And in addition to his scientific background, I would make a case for Bernoulli being the world's first behavioral economist.
Okay.
So this features in the Bernstein book, Against the Gods, but I've sort of committed it more or less to memory. So that the English translation goes, if you're managing money for wealthy people, which clearly by sort of 99, 2000, I was involved in that market. If you're managing money for wealthy people, quote, the practical utility of any gain in portfolio value inversely relates to the size of the portfolio, unquote. Or in plainer English, if you're managing money for wealthy people, just don't lose it. In other words, I mean, I don't think the wealthy are any different from anybody else, except I'm trying to think which American author it was, probably Scott Fitzgerald, who said, they've just got more money than we have. Other than that, I think pretty much everybody's the same. And I would extend this beyond the wealthy. I think it ultimately relates to pretty much everybody. And this has been proven by fairly rigorous scientific studies over the years, not least by the likes of Kahneman and Tversky, namely that people are by and large risk averse. So in other words, the simple way of getting this argument across is if I say to you, look, let's toss a coin. If it's heads, you give me £10. And if it's tails, I'll give you £10. If you end up getting lucky, the £10 or whatever, and insert whatever unit is meaningful of a sort of capital value, the gain generates a feeling of goodwill, but the loss generates such a feeling of ill will that it's more than twice the emotional resonance of the gain. So in other words, we are hardwired to avoid losses. And I thought, well, that's an interesting perspective. Again, this is during the time of the first dot-com boom. We were all watching the likes of Amazon and Yahoo and all these early stage companies as going to the moon. So what I got from that was effectively a confirmation, if you like, that absolute return approaches, capital preservation approaches are a lot more relevant for certainly my clientele then and my clientele now than any other. So in other words, we've never really embraced indexation. We've never really embraced index plus type stuff. We've always been, certainly since then, which is effectively my entire history as a discretionary portfolio manager, we've always been trying to deliver absolute returns, i.e. a cash plus or an inflation plus return, because everything that's market relative ultimately, at least 2 years out of 5, is going to lose you money, and you can't take negative returns to the bank. So that was hugely influential. The other one, which then takes us into the wider realm of economics, is this book, The Origin of Wealth by Beinhocker, which I probably need to go back to because I thoroughly enjoyed reading at the time. And what I got from the Beinhocker book, and it gave one specific thing, which is basically the history of modern economics. I mean, I'm just ripping off Beinhocker, so I'm not saying anything original, but I've written about this on numerous occasions. And it basically, I think most of the commentaries tend to blame Léon Walras. So Walras was, by all accounts, a French dilettante who singularly failed at everything he put his, we're talking about the late 19th century now. He singularly failed at everything he put his hands to, including journalism, brackets, ... Draw your preferred conclusion there. And even at banking. So it failed at everything. And in desperation, and I'm sort of paraphrasing what I remember of the Eric Beinhocker book, sort of Walras Sr. takes his son for a walk and says, my son, I think you should put your hand to this new business of economics, or whatever they were calling it then. And so Walras then basically proceeded to nick a whole bunch of principles from the world of physics, which is a hard science, and then applied them to the then modern economy. As I say, I studied English, so I'm uniquely independent from the sort of the whole economics debate because I didn't play any part of it. But what I distinctly got from reading this stuff in the Beinhocker book is that the foundation of what you might call mathematical economics or scientific economics, it's all complete nonsense. So F equals MA or whatever the expression is in physics may well work. And we know about the laws of gravitation and, quantum mechanics and all this other stuff and Newtonian physics. But the idea that you can boil or distill the essence of the modern economy into a few platitudinous, equations is so simplistic and overly simplistic that it's always seemed to me somewhat absurd. So basically, at around the same time I was reading this, I was also starting to move in circles that you could best describe as Austrian, i.e. classical economics circles. And although I've never studied this stuff extensively. The thinker I'd probably credit who's had more influence on my economic grasp of things, in as much as I have any at all, is Ludwig von Mises, who's one of the fathers of the so-called Austrian school. And if I was to boil down the essence of what I think I understand about the Austrian or classical school, is basically, or certainly Mises, it's a belief in sound money, small government, and broadly libertarian principles. And I'd say the tragedy of our time is we now have none of those.
Yeah, and I'd say Austrian economists understand that economics is a branch of the humanities, not the hard science.
Exactly. And so the fact that Mises' magnum opus is called Human Action is not exactly a coincidence.
And it's also not a coincidence, I think, that they come from Vienna, which was the birthplace of modern psychology and psychoanalysis.
Exactly.
Yeah, on that point, it made me think of one of my favorite sayings. It's from Richard Feynman, the physicist. He said his job would be so much harder if atoms had feelings.
I haven't heard that one. No, that's one I have to commit to memory.
But I'm ashamed and excited in equal measure by your two book suggestions there, because I don't know of either, but I'm definitely going to look up both.
One of the many tragedies of our times is that the likes of Mises and Hayek lost the battle with the Keynesians back in the sort of the 30s and 40s, and the world is paying the price for that now.
You seem to have three sort of core pillars, which seem to be value equities, uncorrelated assets, and real assets. Have I got that right?
That's absolutely right. Well, at one point, probably about 6 or 7 years ago, we were willing to consider fixed income, i.e. debt, as part of that approach. But we now consider the bond markets of the world to be pretty largely uninvestable. Not that they won't give reasonable returns to people in the short run, but to me, it seems that any bond investor is now dancing on the edge of a live volcano. We may well be 100% wrong, but it strikes me that, let's say, the risk reward for bonds and fiat currency generally versus any other type of asset is so poor now. My colleague and business partner, Killian Connolly, has studied monetary system regime change at the LSE within the last 10 years or so. And I think by what he sort of told me about that experience is that monetary systems tend to have a shelf life of around 30 years. Well, the current ragtag shambles of a system dates back basically to the sort of the Nixon gold shock of 71 and removing the link between the dollar and hard assets. So in other words, it's well outlived its shelf life. And the system is, I would say, almost audibly creaking at the seams now.
Your background in wealth management, the sort of classic 60-40 portfolio was kicked into touch quite firmly by...
Yeah, I mean, I was never really an advocate of 60-40. So for people who aren't aware of 60-40, 60-40 is basically still the industry, I think the financial advisory industry consensus that for a typical private client, you should have 60% of your assets in equities, normally indexed as well, so benchmarked on a cap-weighted basis normally. And then the remaining 40% or whatever the figure is should be in bonds, mostly government bonds, adjust the figures according to taste and adjust according to age. Whereas, given I've already suggested that, bond investors are waltzing around a volcano, would argue the appropriate allocation for most private investors to bonds right now should be zero. The three pillars are, as you say, value equities. So if you go to our website, pricevaluepartners.com, you'll see the name Ben Graham splashed around. It's all over the place like a cheap suit. And Ben Graham, for those people for whom that name is not instantly recognizable, the only thing you need to know about Ben Graham is that he taught Warren Buffett. He taught at Columbia Business School, and I think Buffett is the only student that he gave an A to on the course. And so the essence of Ben Graham value investing is quite straightforward. It's to sum it up into two principles. One is don't buy crap, don't buy rubbish. And secondly, when you found good stuff, just don't overpay for it. This is fairly straightforward stuff. But it's amazing how a growth market can basically just stomp all over any form of mental activity whatsoever. So for growth investors, it's been a fantastic period the last decade or so. And value has radically underperformed on a relative, if not absolute basis. And so as a result, it's like nothing else matters. And if you look back at the last, say, 10 or so years, you didn't have to make too many decisions. With hindsight, you only needed to make one decision. If you wanted to maximize returns, that was simply buy America.
Yeah.
Or more specifically, buy NASDAQ. Or more specifically, buy what are now called the Magnificent Seven. Somewhat ironically now, the Magnificent Seven, the likes of sort of Amazon and Microsoft and Tesla and Nvidia and et cetera, et cetera, et cetera. But to go back to the Bernoulli point, those people are interested in capital preservation. For those people who are interested in genuine capital preservation, just buying NASDAQ is insufficient. It's just not a valid approach. So anyway, so value equity is a part of the pie. They're not the whole, because we have to believe in diversification, especially given the risks in the world today. Uncorrelated assets is a part of the pie, and that's very specifically a type of technical trading price momentum approach known as systematic trend following.
Yes.
And if people are unfamiliar with the trend following story, then there's a fantastic website called trendfollowing.com, which is run by a guy called Michael Cavell, who is effectively an ambassador for this whole trend following industry. I've gone on record as saying I think trend following is the best kept secret in finance. An example, first of all, what do? Trend following funds simply track multiple markets, and they can trade on the long side and the short. And unlike most discretionary managers, and like all discretionary managers, they're the opposite effectively of like value investing, because price is key, but it's not like a high price is worse than a low price. They are concerned about momentum. So at any one time, a typical trend following fund will be tracking markets, say in hard commodities like zinc and copper, soft commodities like corn and wheat, equity indices, currencies, interest rates, the works, in other words. And as I say, they can trade to the short side as well as the long. This is typically done through futures contracts because they're the most deep and liquid markets in the world. An example trade might be, say, the algorithm, the system for a given manager says, gold is in an uptrend. So let's go long a unit of gold at, let's say, $2,000, for example, with a stop loss at, say, 1950. Assuming they don't get stopped out, they may then initiate another trade, which is go long another unit at, say, 2100 and raise the stop to 2000. So what a typical trend following trade will be like, it's like pyramiding into a given market where the manager is over time is increasing his exposure to a given instrument, to the long side or the short. They're completely agnostic as to market direction. But crucially, they're not increasing their risk, because if they use a stop loss, they can dynamically adjust the stop loss. So what you have is, the first, you get access to a much wider range of assets, namely things like commodities, which most managers will never touch. There's so much bias against commodities. And secondly, because they can go short as well as long, you're genuinely hedged. I mean, the term hedge fund is widely used and widely abused, but it used to mean something, which meant you actually hedge your traditional portfolio risk.
Yes.
But that hasn't been the case realistically for hedge funds now for decades, whereas trend followers do actually fulfill that activity. A friend of mine runs a small trend following fund, and as an exercise, there's a bit of a laugh. He said, okay, let's just do some sort of crude analysis. So he said, let's try and put together a list of the best performing funds in the world. And the criteria will be as follows. To get onto the shortlist, the fund in question has to have an unbroken 20-year track record, which is difficult because most managers or funds just evaporate before then, or the guy retires or gets fired or whatever, or dies. And secondly, that track record of 20 years has to have basically an annualized average return of 20%, which is almost impossible.
Sure.
There's such a high hurdle to surpass. Anyhow, he came up with 11 vehicles that met those criteria, 20-year track record of at least 20% per annum. Of those 11 vehicles, of which Berkshire Hathaway, technically speaking, isn't a fund, it's as we know, it's a diversified holding company. Berkshire Hathaway only just made the final cut, so it's at the bottom of that list. But of those 11 funds, 6 of them are trend following funds. And the first time I saw this, I'm thinking, there is clearly a story here. So as I say, trend following funds, we would consider as a strategy the best kept secret in finance, in part because they're structured invariably as hedge funds, at least at the parent level. Those can't be marketed to retail investors anyway. The regulator doesn't allow it. So most people never get to hear about them. But the other reason they're difficult to access is because a lot of the fund platforms on which people tend to be dependent don't hold them either. So even though you can hold them in UCITS form, which is the onshore regulated equivalent for fund regulation, most people never get to hear about them, which I think is a tragedy. I'll finish my pitch for the trend following industry by pointing out that in 2008, the worst year for financial markets in living memory, every trend following fund pretty much made money, and some made money hand over fist because they can go short. So you've got these huge advantages. They're great portfolio diversifiers, unlike, say, bonds now. And they have the facility to go short, which is a huge advantage. And if they're doing their job properly, they take out all the emotion from the investment process. It's more just like simple trading rules that are rigidly followed. And then the third component part is real assets, which is basically tangible, non-financial things that if you drop them on your foot, it hurts. Okay. And for us, at a time when we're massively concerned about the debt predicament around the world, example being the US, I'm not picking on the US, it's one of the largest debt markets. The official national debt, which is underreported, it stands at $35 trillion. growing at the rate of $1 trillion every 100 days, that money will never be paid back in anything except devalued dollars. We are going to encounter some form of monetary system regime change. And whatever happens, I think that the history of economics and the history of government debt tends to suggest that those people who are on the wrong side of that reset when it happens can lose potentially everything. And in extremis, that could be having money in bonds. So that's the reason why we want to own tangible real assets. And that's things like gold, silver, commodities generally, and specifically commodities mining companies that we think are fairly priced. So those are the three.
Does it include energy?
Yes, it does. But at the moment, we're finding there's so many compelling opportunities in the metal space. We haven't got as much energy as we like, because we think that's a more expensive part of the market. But at some point, it will definitely include things like nat gas and oil. But it's basically just real assets in all its various forms. And right now, the reason we're primarily focused on gold and silver related investments, including the miners, is simply because that's the cheapest part of the equity market we can find on Ben Graham analysis by miles.
If you're enjoying this podcast, please subscribe via your usual podcast platform, or maybe leave a review or share it with a friend or colleague. If you have any suggestions for future episodes or just want to say hi, then drop me a message at inthecompanyoofmavericks.com. I've got to ask the Bitcoin question here. Does it include Bitcoin?
Not yet, not for us. So that's no disservice to Bitcoin. So I've already hopefully sort of polished my sort of sound money credentials and my sort of
Yes.
negative view on fiat credentials. So taking a leaf out of Mises' book, I think he would probably agree that, in a free market, let 1,000 flowers bloom. So the only real reason why we don't yet invest in Bitcoin is because using the word investment is probably the wrong word. It feels too much like speculation right now. Yeah. And Ben Graham was very clear on the distinction between investments and speculative, trades. So I don't know what it will take for Bitcoin to form part of our portfolios, but the reason we're comfortable allocating things like gold is because it's been around as money good for thousands of years. Bitcoin's been around for a decade or however long it's been. And also, as a champion Luddite, I can't yet fully explain or rationalize myself whether Bitcoin ultimately, we are told it's limited to 21 million units and blah, 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 but I'm not a coder, so I can't independently verify that. Looking back on the last 30 odd years that I've been working in the capital markets, I suspect that most people involved in the business at heart are actually closer to being traders than they are to being investors. And I think the journey that I like to think I've been on is you start out as a trader. In other words, you kind of have a view about everything, but it's quite likely to be wrong. And then after a while, if the sort of value bug hits, then you become an investor. So you start to think more like an investor than a trader. And then if you really get to the top of the mountain, and this is where you get into like Buffett and Munger territory, you start to think like an owner. And in each case, your sort of zone, your circle of interest shrinks. It doesn't grow, it shrinks. So by now, for example, where I am mentally and where our business is and where my colleagues are mentally, I like to think we're looking at a fairly narrow world of things where we think we know what we're doing and we know what characteristics make sense. So, for example, I gave a sort of quick and dirty definition of value investing earlier. In other words, don't buy rubbish and don't overpay for good stuff, which I still think is absolutely valid. But to go just a little bit beyond that, you can nail it down with some other features like, for example, only buy businesses that are generating scads of cash, point one, and point two, don't buy businesses that have a lot of debt. And in each case, you're just getting closer and closer towards that capital preservation ethos, which is if the economy is about to enter a rough patch, companies that are heavily leveraged may well not make it through to the other side. So there are some fairly straightforward things you can do to avoid that prospect. Again, it's not rocket science.
You have to stay in the game.
Yeah.
I was going to say, how do you avoid a value trap? But I think you've described those characteristics, and its debt usually has a lot to play.
Something that's outrageously cheap gets even more outrageously cheap, and then you think, well, it's never going to recover. And then you're waiting for some kind of catalyst to change the game. But I think the most honest way of answering that question is you avoid value traps by just diversifying. In other words, you don't have all your eggs in one basket and then expect it to shoot the lights out. The nature of the world is that things don't work exactly as planned. So I forget who it was who said, no battle plan survives first contact with the enemy. So you just have to be adaptive. But ultimately, the way to avoid that is diversify by holding and by sector.
I think it was Mike Tyson who said everyone has a plan until they get smacked in the face.
Punched in the mouth, exactly.
Yeah.
It's good to know that we can seek investment wisdom from esoteric sources.
Why don't these returns that the trend following funds become competed away as technology improves and the world adopts artificial intelligence? How have they been so sustainable, and how can you be confident they will sustain in the future?
That's a very good question. I think the way I would answer it would be, I'll slightly veer off the subject just so I can cram in a cheesy quote, because it's a long-standing addiction of mine is to deploy cheesy quotes with abandon, like anti-flak devices from chaff from a fighter plane or something.
Yeah.
So basically, there was a time when long-term capital was trying to raise money from investors, and they went to an insurance company in the States. And one of the guys on the insurance panel who they were pitching to said, guys, I just don't get it, because ultimately what we're doing is basically arbitraging between very similar bond type investments. And he just couldn't see where the returns were coming from, brackets, in a heroic use of leverage. And he said, I don't see where these returns are coming from. And one of the guys at Long-Term Capital said, because of idiots like you, that's how we can get these returns, which always struck me as perhaps not the shrewdest play when you're trying to raise money from someone by calling them an idiot. But I mean, what do I know?
Because that was the very same long-term capital management that sort of didn't see the game out.
Yeah, exactly. So long-term capital lasted about 3 years after that, after that particular fundraising round. And then, of course, it blew up because it had too much leverage. And it was also, again, it had an insufficient data history, a data set, so that it wasn't prepared for a market irregularity that was unlike the last, say, 10, 15 years. But I'm being sort of semi-facetious, but I honestly think that the reason, to go back to your question about trend following funds not being, the returns not being competed away, I think it's because human nature doesn't change. So I think, firstly, my awareness of the sector is that in the greater scheme of hedge fund pools, it doesn't manage as much money remotely as, say, equity long short or global macro, any of these other strategies that hedge fund managers tend to use. So I think, firstly, the pool of capital is smaller, but I think more to the point, it goes back to things like, reminiscences of a stock operator by Edwin Lefebvre, which is a thinly veiled disguise for Jesse Livermore. And Livermore, who was one of the most successful traders on Wall Street back in the first half of the 20th century, and he made money out of the crash in 1929. He was basically saying this thing, which is human nature doesn't change. So for as long as the fact that human nature doesn't change, the market will be blown between waves of fear and greed. And for as long as that happens, trend followers will make money because all they want to do is just ride trends. So whereas a value manager like us might well be on the sidelines almost indefinitely because a given thing is too expensive to buy, the trend follower, by contrast, will say, well, we don't have a view on whether it's expensive or not. We're just going to ride the trend for as long as it lasts. So there's this expression, the trend is your friend until the end when it bends. So when the trend then reverses, they're out. So they're not going to ride in perpetuity. They never get the top,
but who does?
And they never get the bottom, but nobody realistically ever does unless you're fraudulent. And I think that's why it works. It is basically one of those strategies that simply exploits the fact that human beings are overly emotional. Perversely, it's the same reason why value investing also works, is because you're exploiting other people's irrational despair.
Correct. Yes, I get that entirely. I can see it. I just hadn't considered it as an uncorrelated return asset. But of course,
you're right to raise the question. It may be that at some point it fizzles away, but thus far, I mean, one of the funds we use is set up by a guy called Bill Dunn, who's been in the business for over 40 years now. So a fantastic long-term track record. And although trend followers did not shoot the lights out in the recent past, so sort of the mid-teens, 2015 and so on, that may in large part be a function of the fact that at any one time, they're actually not invested. They simply have their capital as dry powder in the form of T-bills. So when basically the interest rate pertaining on T-bills goes to zero, their carry disappears as well. So I think there's a number of reasons why they were in the doldrums, but they've come back very happily over recent years. So they're doing very, very well year to date, and they had a decent year last year. So again, just like value, I think the debt of the trend following funds has been widely overstated.
The period of zero interest rate policy and for the last decade has also been a poor period for long short equity, for absolute return funds investing in equities.
That is a sector that I would say is potentially very, very overcrowded. And again, also the beneficiary is a sector from huge amounts of data analysis and what would now, I guess, be AI. So I think if there is a crowded trade, it's basically in long short equity land.
Okay.
Because you've got some of the brightest minds in the world all looking at the same problem
trades
through the same prism. And as a result, don't expect to make super large returns in that environment, because it seems to me that's a very crowded. I would humbly suggest that the average manager shouldn't be doing both long and short, because I think you need a very specific mentality to be a successful short trader.
Okay.
Because it's a completely different mindset.
I think that they do exist, but I agree.
I don't doubt.
It's very rare, and I think, but I know.
I mean, I was speaking at a conference I got invited to. This was, I think, Agora, probably part of Bill Bonner's empire a few years ago. And there was a guy there, I think it was in Vegas, and there was a guy there who was saying he was a dedicated short seller. And he just described his strategy as basically, well, I try and find wounded animals by the side of the road, and then I just reverse over them a few times.
You talked about looking at the history of monetary resets. Are we approaching that point? Is there any way of knowing? What's your take here?
You imagine snow falling on a snow mass on a cliff. It is possible to identify when the system shifts from being in stable equilibrium to moving to unstable equilibrium. But thereafter, you can't forecast which snowflake is going to cause the avalanche. The closest you can get is acknowledging the system's no longer safe. And I think that's where we are now. I think most sensible people would conclude that this is desperately unsafe. The fact that we're speaking in a week where Intel lost, was it 20% of its value?
At least, yeah.
From one day to the next. So
we've had NVIDIA.
NVIDIA as well.
There's been their average sort of intraday trade has been sort of between 5 and 10%, and this is half
the GDP of Western Europe or something crazy like that.
I mean, so it's come back to your point. When we talked earlier about understanding how markets and economies work. I mean, they are a complex adaptive systems.
For sure. There's a thing called the Edict of Diocletian, and Diocletian was a Roman emperor who parachuted into office or murdered his way into office, and basically was beset by a number of problems, one of which was that the Roman army was overextended, so he had this massive military complex overseas that was leading to all kinds of inflation. Does any of this sound strangely familiar to you? So you've got all these issues.
Yeah, I think I've seen the movie, yeah.
I think we've all seen the movie, and enjoy the party but dance near the door, so you may want to leave this on before it ends. And so Diocletian's basically got all these problems, and like everybody else, he resorts to the time-tested things like clipping the coinage and adulterating the silver denarius with copper and all these kinds of things. It doesn't do any good, so he has this huge inflationary problem, and the economy is collapsing. So his way of attempting to deal with this is by issuing the infamous Edict of Diocletian, one part of which says grain prices will not rise on pain of death. What do we think happened to grain prices after the Edict of Diocletian was issued? They still went up. So in other words, governments will attempt to do all kinds of things to pander to whatever lobby groups and interest groups they're trying to pander to. But ultimately, the market will have the final say. I think the perversity of the world is that you can actually buck the market for quite a long time. And that time could be longer than anyone ever anticipates.
I don't know who said it, but it's along the same lines as nothing is more unstable than government measures to stabilize markets.
For sure. So
and interest and the price of time, interest is a control. Well, at the short end, for sure, is a government-controlled price.
So I think one great example of this is that you look at the history of the Soviet Union. So the history of the Soviet Union is that you have this vast empire that was sort of created in the chaos of 1917 and the revolution. Most objective observers would then say that the whole thing was completely untenable for as long as it lasted. But the Berlin Wall didn't fall until 1989. Yeah. So you had 2 generations of people living through an appalling economic experiment that was destined to go badly. But the point was, if you had the misfortune of time, in other words, you were born at the wrong time or were involved in this chaos at the wrong time, your whole life was spent in chaos, in economic chaos. So, these things can last way longer than you think. I was asked by the publishers Harriman House in 2016 if I wanted to write a book about investing, which I did, which is called Investing Through the Looking Glass. The weird thing about that was I was concerned about all of these things we're now talking about, but this is getting on for 10 years ago. And having finished the proofs midway through 2016, I was then desperate to get the thing published because I didn't want the twilight of the gods moment to happen before the book was out. And so that's 2016. It's now 2024. The same problems are out there. They're bigger now than they were then. And it's like, how long does this game continue? But to go back to your much earlier question, I do think we are close to a tipping point. There's a great phrase, I forget who I should credit with this one, but there's a great phrase of they are going to ridiculous Basil Fawlty-ish lengths to try and keep the show on the road. But it's absurd. Or to use a line from Armando Iannucci, this is like a clown running through a minefield. every time you have government intervention, the government intervention then requires more government intervention to counteract the ill effects of the first intervention. It's a self-fulfilling prophecy, and it just spirals out of control.
What's your take on the recent market volatility that we've had? And it's all to do with this yen carry trade. Is this going to be a minor episode, like a flash crash that is going to be put back together and will carry on? Or is this
I think there's only so many times.
A deeper foundation.
I think there's only so many times you can keep doing this. So the biggest fear I have is that, I think the way I've expressed it is that central banks call a new bull market and nobody turns up. So they do everything in their power to try and suck in the last punter, but the system's just too exhausted to continue. So I met a fund manager at the start of the millennium, so around 2000. This is, again, one of those quotes that lives with you. So live with me, which is, Japan was the dress rehearsal. The rest of the world will be the main event.
Yes.
And at the time, that struck me as an absurd thing to say. And now, from the perspective of 2024, it doesn't look so absurd anymore. In other words, and Japan is such an incredible lesson or incredible set of circumstances. So this all happened shortly before I started work in the business. But no, just to recap, Japan had its sort of bubble market in the 1980s.
Okay, I've just got my trivia question for you, Tim.
Yeah.
Can you name the 10 largest banks in 1989 globally?
IBJ.
They were all Japanese. I think 9 out of 10 were. There was one.
Mitsubishi Tokyo, they'd all been Japanese, maybe from JP Morgan or something.
No, it was French.
Credit Lyonnais.
Yeah, it was the 10th largest, or 9th or 10th.
My world,
bank.
we are. That is one for the history books, isn't it? I'm really feeling my age now.
And the Japanese equity market accounted for something like 55% of total market cap.
Total world market cap, so incredible. And then there's the one that everyone knows, which is the grounds, the Imperial Palace in Tokyo, worth more than the state of California.
Yeah.
So you had this extraordinary bubble, extraordinary boom, property boom, stock market boom, bond market boom, and then that all came to an end because, the tree cannot grow to the sky.
Sure.
And then the astonishing thing about, which I think even now is not fully recognized, the amount of wealth and capital that was lost after the 89 peak was the equivalent of 2 American Great Depressions. Japan suffered effectively 2 1930s back to back. Quite an astonishing destruction of wealth. And the point I'm making is that unlike America or probably any other Western economy, Japan came through that with a remarkable degree of social cohesion and stability, which I think would be impossible in the West now.
It would.
If it were ever possible. So
you think we're all turning Japanese?
Exactly. So I think, per the guy who said, no, the rest of the world will be the main event, that is now taking place. And the first country where that's taking place is actually China. We invest with a manager. He's made this point on numerous occasions over the last few years, which is China now feels an awful lot like where Japan was after its market peaked in the 80s.
Yes.
So you have all these basically bridges to nowhere and zombie type businesses.
Debt deflation.
And it shows you the malign impact of government intervention, which is the government is determined to keep things afloat because it can't have a crash. And almost by definition, if you can't have a crash, then you must have a crash. It's everything to do with the fact that an overly financialized world has reached the practical limits of debt issuance, that all that debt is doing is clogging up the arteries of global capital now. And all of that debt is hindering the free market process because governments and regulators will do what they can to keep the bandwagon rolling, but that will crowd out more meaningful investments from a free capital market. So I would struggle to be upbeat about the next few years in capital market terms. Clearly, we like the prospects for value stocks. We like the prospects for momentum strategies, and particularly like the prospects for real assets. But for assets writ large, I find it almost impossible to be optimistic at this point. We're living through a sort of weird quasi-communistic world in the West. And I think increasingly people are beginning to realize that.
I think 1984 was a how-to guide, really, wasn't it? Thank you so much for doing this.
Pleasure. Thanks for inviting me.
How do people follow what you're doing?
Yeah, the best way probably is simply to go to the website pricevaluepartners.com. And if people want to read or subscribe to the weekly commentaries that I put out and to our app, but more generally, there's a commentary section, key documents, and I think it's just called commentary. I have a Substack and I do all the usual social media stuff, but just going to the website will be sufficient. People can have a mooch around there to learn a bit more about us. It's pricevaluepartners.com.
That's great. Thanks very much.
Well, Jeremy, thanks again for the kind invitation. I've thoroughly enjoyed it.